So today I'm going to talk about FHA loans. Many people will be presented an FHA loan when they get ready to buy a house. Typically, the lender will present an FHA loan because the buyer doesn't have a large down payment, and you can put 3.5% down on an FHA loan. And depending on the county, that loan can be 5, 6, 7, sometimes even $800,000 and more, depending on where the house is. So 3.5% is a very, very small down payment for such a large loan. But it works on smaller loans if people don't have a lot of money. And then there's down payment assistance, grants, and other down payment assistance loans, which can help you with the down payment. But the four things you really have to consider when you're doing an FHA loan are your income, your credit, your assets, and affordability. And affordability is not really a criteria, but it's something you really need to take into consideration when you're doing any type of loan. So as far as income, the interesting thing about FHA loans is they will actually allow you to go as much as 57% of your gross income for your mortgage and all your debt. So that's a substantial amount. If you were making $10,000 a month, that would allow the mortgage and all the debts to be up to $5,700, which is a large percentage of your income. And it really works in many cases where maybe there's some undocumented income or a spouse that can't go on the loan. So there's additional income, and one person has to qualify for as much as they possibly can in order to get the house they want. A little unknown fact about FHA is there's also a front-end ratio. And what I mean by front-end ratio is your mortgage payment can't be more than 46.9% of that gross income. So you got to consider that there's a limit on the mortgage payment. If you have no other debt, you're not going to get to go to 57%. You're going to get to go to that 46.9, and then the balance would be used towards debt. But most people's front-end ratio is not that high. As far as the income on an FHA loan, they're typically going to ask you for 2 pay stubs, 2 years W-2s, and they're going to do an average of last year and year to date for income. Now, it's going to be treated differently, whether you're salary, hourly, commission, that kind of stuff. Salary is very simple. You can just take your salary divided by 12. You get the same amount every 2 weeks. Hourly, they're going to look at an average of the hours last year and this year, and then they're going to make a determination what that income is. And then if you're self-employed or commissioned, you're going to get into taxes and other documents in order to qualify. So there's definitely additional criteria as far as qualifications. And the income part, as far as documenting on an FHA loan, are actually slightly tougher than a conventional loan, even though they're much looser in other areas. So you have to be aware of how much income you make and what you qualify for. And your lender is going to calculate the debt ratio, the front end and the back end debt ratio. The next thing about FHA loans are the credit. So you hear a lot that you can go down to a 580 credit score on an FHA loan, and that is correct. Typically at a 580 credit score, the rate's going to be slightly higher, or the costs are going to be slightly higher. But there's interesting things on FHA loans where medical collections won't count against you. If you have other types of collections, they will allow the loan to go forward. In fact, they'll just take a percentage of those collections and count it in the debt ratio. And if you have a charge-off, it's pretty much dismissed. It doesn't even count against you in any way. That means the person that has the debt, or the company that has the debt, has forgiven the debt. The other thing about FHA loans is they allow you to buy a house 24 months after you've had a bankruptcy and 36 months after you've had a foreclosure. So it's pretty forgiving on the credit. And so it's a much easier way to go forward than a conventional loan, which has much more stricter guidelines as far as credit goes. Then the next thing on an FHA loan is assets. So this is interesting because the loan requires 3.5% down. So if you were buying a $500,000 house, it would be $17,500 just for the down payment, not for the closing costs. But on an FHA loan, if you don't have the down payment, there's many down payment assistance programs through different states, through counties, through cities, just a bunch of different options as far as the down payment. And in fact, there's even programs where you can borrow the down payment as a second mortgage. So you could, in theory, get 100% financing. And in those situations, you don't have to put a down payment on the house. Now, there is closing costs on an FHA loan in addition to the down payment, but you can actually get the seller to pay as much as 6% of the purchase price towards closing costs. So in a situation where you were buying a $500,000 loan, you could get as much as $30,000 in seller help, which is a lot. You probably won't get that from most sellers, but it is available. One thing you have to consider on an FHA loan is they are going to ask you for bank statements. And typically you're going to provide 30 or 60 days bank statements. In most cases, you're going to provide 60 days bank statements. There are some ways where you wouldn't have to do that, but in most cases, and FHA does not want to see large deposits. If you have a large deposit, that income can be excluded. The other thing on an FHA loan is if you're getting a gift, the person that's giving you a gift is going to have to fill out a donor letter. And then in addition to filling out that donor letter, that person is going to have to provide their bank statements, which are going to be part of the underwrite, because on the FHA loans, the underwriter wants to see that the person that's giving you the money also didn't have large deposits. So when you're getting a gift for somebody and you're doing an FHA loan, the person that's giving you the gift has to be prepared to not only fill out a gift letter, but also provide their bank statements. And some people don't want to do that, but it is something that happens. And the last thing that I'm talking about is affordability. You have to be really, really cautious when you get a loan. And what I mean by that is in terms of the monthly payment, because FHA allows you to do such a large percentage of your gross income. You have to really look at how much you can afford each month to make sure that the payment that you're making is something you can actually afford and something you can actually make. FHA will allow you to qualify for much larger payments than conventional loans, but you still have to make that payment. And if that payment is too high and you find it unaffordable, you might find yourself in a situation where you can't make that mortgage payment and you can lose the house. But FHA is a great way to get into the house. It has lower down payments, lower credit scores. There's options as far as on the down payment assistance and loans. And if you're looking to buy a house, you should definitely consider it as one of the options. It's not the only option, but it's definitely one of the options, and it's a good one.